For many, buying a home is a monumental step. Yet, diving into the world of investment properties can amplify its significance. What if I told you that the right mortgage could also be the key to unlocking your financial freedom? Welcome to MoneyWise. This channel aims to offer realistic and straight-to-the-point financial insights and money tips. We hope to help people who have just started their financial journey, wish to build their wealth, improve their personal finances, budgeting, and investments. Selecting the right mortgage is like fitting the right piece into your financial puzzle. So, how can you let a good mortgage work for you? Stay with me until the end of the video, where I'll unveil a handy tool to streamline your mortgage analysis. You won't want to miss it. Tip 1. Understand your mortgage. Know your mortgage inside and out. Understand terms, interest rates, and any potential fees. Remember, knowledge isn't just power here, it's a tool for financial leverage. And in the world of home ownership and investment properties, this understanding could translate to significant savings. A simple example is, suppose you have a 30-year mortgage for $500,000 at a 5% interest rate. Over the course of the loan, you pay roughly $466,000 in interest. However, if that interest rate were to decrease by just 1%, you would save a little more than $100,000 in interest costs over the life of the loan. Let's look at another example. Banks view your primary residence mortgage differently because it doesn't produce rental income. If you hold mortgages on both your personal home and an investment property, prioritize paying off the one on your primary residence first. By doing so, you can 1. Wipe out debt that doesn't produce income. 2. Increase your borrowing potential for future endeavors. 3. Take advantage of tax deductions on interest for your investment properties, utilizing negative gearing to reduce your income tax liability. Tip 2. Refinancing when rates drop. Refinancing at a lower rate can save you thousands or even tens of thousands over the life of your loan, freeing up money for investments or other expenses. In Australia, banks tend to reserve their best offers and rates for new customers, rather than rewarding loyalty. This is why it's crucial to reassess your loan terms and rates at least once every 2 years, particularly when interest rates are on a downward trend. Many banks incentivize refinancing by offering new customers not only better rates but also substantial cash rebates, often up to $4,000. Considering that the typical refinancing costs are usually below $1,000, this not only means you can secure a better rate but also gain a cash rebate. This extra cash can be used to reduce your mortgage further, enhancing your financial position. Tip 3. Make regular and one-off extra payments. On a $500,000 mortgage with a 30-year term at a 5% interest rate, making an extra $500 payment each month can help you pay off the loan 8 years sooner. If you up that to an extra $2,000 monthly, you're looking at clearing the loan in just 12 years. That's 18 years ahead of schedule. Regular monthly overpayments significantly speed up the mortgage payoff. Additionally, whenever you come into unexpected income, like bonuses, commissions or tax refund, consider making a one-off additional payment. This will further boost your journey to becoming mortgage-free. You can also leverage an offset account to minimize interest costs. Wisely use your credit card for daily expenses, while depositing your earnings into the offset account. Why? Most credit cards come with an interest-free period, often up to 55 days. By using your credit card for daily expenses, you can take advantage of this period. Essentially, you're delaying the actual payment of those expenses until the due date on the credit card, allowing your money to sit in the offset account longer, thereby reducing mortgage interest for a more extended period. By maintaining a high balance in the offset account for as long as possible, you can maximize your savings on interest and pay off the loan sooner. Tip 4. Consider rental income. Got extra space at home? Think about transforming that space into a source of income. Whether you're looking at long-term leasing or short-term options like Airbnb, especially during your own holidays. Let's take an example. If you lease a room for $200 per week, you'll accumulate an additional $10,400 annually for your mortgage. However, if that same room can fetch a net revenue of $150 per night on Airbnb, and you rent it out 50% of the time, you could be looking at an annual income of $27,375. This additional revenue can significantly counterbalance your mortgage payments. By tapping into this potential, you're not just making use of idle space but also fast-tracking your journey towards financial independence. Tip 5. Boosting income, the side hustle strategy. Build side hustles based on your skills and interests. Some examples include freelancing, affiliate marketing, e-commerce, dog walking, pet sitting, etc. Just ponder this: an added $200 weekly equates to $10,400 annually. A side hustle isn't just an avenue for extra cash. It's a strategic tool that, when used effectively, can significantly shorten the duration of your mortgage, bringing you closer to the dream of complete home ownership and financial freedom. Tip 6. Smart use of HELOC. A home equity line of credit, or HELOC, functions similarly to a credit card, giving you access to a set credit limit and charging interest only on the funds you use. But can you leverage a HELOC to settle your primary home mortgage in Australia? Absolutely. Let's imagine your home's value is now at $800,000, but you've only got a $200,000 mortgage remaining. In such a scenario, you could potentially secure a HELOC to cover and retire this mortgage. Now, you might wonder, isn't this just shifting debt from one place to another? While at a superficial level it might seem so, the transition offers several advantages. 1. Flexible repayments. A HELOC offers more payment flexibility compared to a standard mortgage. You have the autonomy to borrow, repay, and reborrow as per your financial needs, up to your credit limit. 2. Interest-only options. Some HELOCs present the option of making interest-only payments for a set duration. This can decrease your immediate monthly expenses, though it's crucial to note that this approach might extend the loan term and total interest if not properly managed. Maintaining discipline in repayment is key. 3. Debt consolidation. Moving your outstanding mortgage to a HELOC centralizes your debt. This streamlines your financial management with a single monthly payment and a consistent interest rate. 4. Tax-deductible interest. In Australia, the manner in which you utilize your HELOC can have tax implications. If you draw from a HELOC tied to an investment property to settle your primary home mortgage, the interest on that HELOC could be tax-deductible. This strategy can lead to meaningful tax savings, maximizing the benefits of your borrowing strategy. 5. Access to equity. You can tap into the equity you've built up in your home for other financial needs, not just for paying off your mortgage. This could be used for home improvements, investments, or other purposes. Choosing this route, however, requires careful thought and ideally, consultation with a financial expert to ensure it aligns with your long-term financial objectives. Tip 7. Streamline your financial obligations. When managing mortgages across multiple properties, a strategic move is to assess the growth and equity of each asset. Should one property significantly appreciate in value or possess considerably higher equity than the others, you might consider selling it. By capitalizing on this appreciation or equity, you can channel the proceeds towards settling your primary residence mortgage in a lump sum. For instance, let's say you have a home loan balance of $300,000. Meanwhile, one of your investment properties, which has appreciated considerably in value, can now be sold for $750,000. Given that the remaining mortgage on this property is $400,000, the sale would generate enough net proceeds to entirely pay off the mortgage on your primary residence. This not only secures your primary home but also streamlines your financial obligations, allowing you to focus on optimizing the returns on your remaining properties. Tip 8. Avoiding PMI. Private mortgage insurance, or PMI, is an extra cost for those who can't put down 20%. By saving for a larger down payment, you can avoid PMI and also get a better interest rate because a substantial down payment reduces the lender's risk, suggesting that the borrower is more invested in the property and less likely to default on the loan. As a result, lenders are often more inclined to offer favorable interest rates to borrowers who can make a sizable upfront contribution to their property. Tip 9. Tax benefits. Don't forget about potential tax benefits. For your investment property, mortgage interest deductions can offer substantial savings. Consult a tax professional to maximize these benefits. As mentioned previously, there's a link provided below for a straightforward mortgage calculator tool. Just input your loan amount, term, and interest rate, and it will display your minimum monthly repayment, breaking down the interest and principal components on a monthly basis. Additionally, you can enter an extra monthly repayment amount to find out when the loan will be paid off. In the world of financial freedom, a mortgage isn't just a debt, it's an opportunity. By mastering your mortgage, you're not just buying a home, you're paving a golden path towards a brighter financial future. If you enjoyed this video and found value in it, please give it a thumbs up. Don't forget to subscribe to our channel for more content like this. If you have any questions or topics you'd like us to cover in future videos, drop a comment below. Sharing is caring, so feel free to share this video with friends and family. Thanks for watching, and we'll see you in the next one.